Most people think successful investing is finding the next Apple or timing the market perfectly, but it's not. The best investors in the world follow some basic, boring rules.
Well, I think it's all working. It's all working
Consistently, while everyone else chases the next popular cryptocurrency. And then they wonder why they never build wealth. I've spent years studying personal finance and what builds real wealth and what is fake hype. People that sell everything and then swear they're never going to touch the market again. And what I found isn't actually that complicated. It's not a secret formula and it's not insider knowledge. Anyone can apply it. It's 5 rules. Stick around because by the end of this video, you're going to have a simple framework that usually costs people decades and thousands of dollars to figure out. So welcome back. If you're new here, I'm Alice. I'm a chartered accountant and I am interested to teach you all everything to do with personal finance and building your wealth, especially people that have some money but don't know what to do with it. Today is one of the most important videos I've ever made because these 5 rules apply to anyone, whether you're just starting out by investing 100 a day or whether you're quite a successful investor and you've been investing for years. I'll go through each rule and explain why it works and how you can apply it to your life. Okay, so these are the 5 rules. Rule 1, invest in what you understand. Warren Buffett calls this the circle of competence. The idea is simple. You put your money into things that you actually understand. You know what the company does, you know what value they provide. This is especially important when you're investing in individual stocks. I always recommend people invest around 10% of their portfolio as like fund money in individual stocks. And it's very important that you know what you're investing in. What do they sell? How do they make money? Why do customers keep coming back to them? How are they growing? How are they innovating, especially in the new AI era? If you don't answer those questions, it's not a good idea to invest in them. Here's where most people go wrong. They invest in something because they've heard a tip from someone about how it's the next big thing. Friend mentions a biotech company that's got a new drug out. You don't understand biotech. You don't understand the FDA approval process. You don't know drug trials or pharmaceutical economics. And then when the stock drops 40% because a trial didn't work, you have lost a lot of your hard-earned money. And this is because they didn't understand what they owned, so they put loads into it and had a lot of confidence because somebody told them about it. But let's compare this with somebody that works in, say, retail and they really understand the fashion market. They put money into a luxury brand and they know this brand is going to do well. They understand retail, they understand brands, they understand hype versus actual customer loyalty. Then they have an edge on a random trader who's just deciding to risk it all for that company. Now, does this mean you can only invest in one industry? Absolutely not. You just need to research the individual stocks that you're investing in and understand that market, that industry. It doesn't need to be an in-deep level, but it needs to be a general understanding of what makes a company successful and if that company is going to do so. For example, I decided to invest in Meta around 4 years ago and they have performed phenomenally. But I didn't do it out of nowhere. I was listening to a podcast where the VP of Meta in EMEA was talking about all their plans for the future. And it was so inspiring. And I remember I was doing the Camino de Santiago and I was like walking, listening to this podcast. And I thought, I need to invest in this stock. So I put not loads of money, wish I did more, but I invested into that and I got incredible returns. And I was very confident in putting that money in because I had done some quote unquote research, because I heard a podcast from someone actually working in the company and understanding their mission. So here is your action for number 1. Write down 3 sentences. 1, what does this company do? 2, how does it make money? And 3, what could cause it to fail? If you can't write those 3 sentences with confidence, then it's not time to invest in that stock yet. All right, let's move on to rule number 2. Think long term, not short term. This rule sounds obvious and most people in practice would say that they know this, but they don't actually implement it. So ask yourself a question. If you bought shares in a great business today and the market crashed by 40% tomorrow, would you sell those shares? Most people say no, but when it actually happens, people freak out. Maybe they want to buy a house in a few years, or maybe something happens and they think, oh, I should sell because it might get worse. Watch their portfolio drop 20%, 30%, 40%, and then they panic and then they sell. And that's selling at probably, most likely, the lowest price. Selling at exactly the wrong moment. Look at any long-term chart of an index fund. Take, for example, the S&P 500 here. There are crashes everywhere. 2000, 2008, 2020. Each one looked catastrophic in that moment. Everyone thought, wow, I've lost loads of money. I need to sell. What if this never goes back up? Every single time someone thought this. But in hindsight, each one of those moments was a buying opportunity. Investors who stayed the course and stayed there and didn't sell thrived. The people that bought did incredible and probably very rich right now. And the people that sold completely lost out. Compound growth is like a financial superpower. Einstein called it the eighth wonder of the world, and it really is. It only works if you actually give it time. Do not sell when the market drops. A $10,000 investing growing at 8% per year, a reasonable historical average for a diversified portfolio, becomes roughly $21,000 in 10 years, $46,000 in 20, $100,000 in 30. You need to weigh. And that's if you don't even add any money to it. You can be a millionaire by the time you retire, or even way earlier if you're aiming for the FIRE movement, but you just need to keep that money in there and grow over time and not make emotional decisions. The biggest enemy of long-term investing is the media. It's watching the news. I personally don't like to watch the news. Sometimes I see things on social media, things that are happening in the world, but in general, I don't follow the media so strictly. One, mental health, but two, it can make you panic, especially with your finances, because you think that the world's ending, there's a big war, there's all of these wars, everything's happening, my investments are going down, I need to sell, maybe I need to not buy anymore because it's at a high. No. The antidote is a simple question that you need to ask. Has anything fundamentally changed within that business? Like a fundamental quality? If the answer is no, then you do not sell. I would set a minimum holding period before you buy. Literally write down, I commit to buying this and holding it for 5 years, for 10 years. And then you can come back to that no and see when the market drops. No, I've got to wait. Unless the fundamental business changes. It sounds simple and it will save you a fortune. Let's move on to number 3. Diversify, but don't over diversify. So you always hear, don't put your eggs in one basket. And that is completely true when it comes to investing. I love to invest in the US, Europe, and emerging markets. And I also like to invest in individual stocks, mostly tech. But here's what no one tells you. If you are putting it in 1,000 baskets, you'll spend your whole life managing 1,000 baskets. You still might not outperform someone that literally just holds 1 or 2 index funds. Diversification serves one purpose: to reduce the risk that any single bad outcome destroys your portfolio. If you own 20 companies and one goes bust, it doesn't completely wipe you out. And that's why I love index funds. There are 2 opposite ways people get diversification wrong. 1, concentration, having 80% of their portfolio concentrated into one industry or market or one country. However, there's a term called diversification that was termed by Peter Lynn, and that was about owning so many positions that you cannot monitor them properly. Portfolio basically just tracks an index fund kind of market anyway, but with loads of costs. Cool. So the actionable takeaway here is review your portfolio and ask yourself 2 questions. Am I dangerously concentrated in one market, one stock, or one country? Or 2, do I own so many things that I've lost track of what I own? Aim for meaningful diversification, enough that no single breaking position will break you, but few enough that you can actually stay informed about what you own. Let's go on to number 4, understanding valuation over price. Price is what you pay, valuation is what you get. This rule is where investing is going to get a little more technical, but stick with me. Warren Buffett's mentor, Benjamin Graham, put it best. In the short run, the market is a voting machine. In the long run, it's a weighing machine. In other words, in the short term, stock prices reflect sentiment, hype, fear, but in the long term, they represent the actual value of the company. That means it's actually possible to buy a brilliant company, but at such an inflated price that it's actually a bad investment. Think about the dot-com bubble. There were so many companies that were overvalued and went bust. But there were also great companies like Oracle, Cisco, Amazon. Amazon's stock dropped 90% from its 2000 peak, not because it was a bad business, but because the price had become completely detached from any reasonable valuation. People who bought Amazon at the peak actually made a really bad investment, even though Amazon is such a great company to invest in. But people that bought in 2002, 2003 made incredible returns. You don't need to be a chartered accountant to understand how to read a stock. And I'm going to share that in my next video, so stay tuned for that, about how to read a stock. Okay, and then rule number 5, control your emotions. Here it is, the most important rule of all, the one that separates the investors who build wealth from the ones who don't. The stock market is a machine that is literally exploiting your emotions. Not on purpose, but it does. And when prices are rising, you feel euphoric, you feel rich. But when they drop, you feel like your life is ending or you have lost a lot of money, when actually it's not a realized loss. So there are 2 emotions that you should not feel when it comes to investing: fear and greed. Fear causes investors to sell when the market drops, and people sell at bottom prices. They lock in their losses and they miss any recovery. The 2008 financial crash saw so many retail investors drop out at the low price when the stock market crashed because of panic, because of fear. If they'd have just held on or even bought more stocks at that point, they would be incredibly rich now. Probably some people to even the extent where they could quit their jobs and retire. Because over the following decade, the S&P 500 literally triples. The second emotion is greed. And this causes investors to chase performance, buying what's already gone up, ignoring the valuation, piling into the hype like Nvidia and crypto, the whole crypto bubble peak, the meme stock frenzy. This is what greed looks like in practice. Morningstar's research on investor returns versus fund returns is striking. They found that because investors tend to pour money in after a fund has performed well and put it out after it drops, the average investor actually earns significantly less than the fund's official stated return. The fund did fine, but the human behavior around it destroyed its value. So what do we do about it? First, automate where possible. Set up a regular automated investment every month. So from your bank account to your investment account, say it's a few hundred a month, let's do 500 a month, send that money there, yes or yes, and it gets invested, no matter whether the market's low, no matter whether the market's high. And this is called dollar cost averaging. So you might buy shares at a low price, buying shares at a high price in another month, but that share price, average price, will level out over time. And that means you don't have to make any emotional decisions. It's just a fact that you invest every single month like that. And then secondly, limit how much you check your portfolio. You do not need to be looking at your portfolio every day or even every month. I personally like to look at it every month because I like to have a cash reserve in there. And so if I do see that a stock is low, I like to buy more. But I never sell unless I want to sell to buy a house, which I sold some of my stocks to buy a property, a real estate, Airbnb recently. But if it's not for that, hold onto it. Do not sell in the short term. Just keep automating it. You don't even have to check your portfolio at all. The Fidelity study found that the best investment accounts were from people who had forgotten their password or who wouldn't. And then third, write down a plan. Write down, when should you sell? Is that buying a property? Is that when you reach a certain age because you want to do the financial independence, retire early plan? Write down in what situations you would want to sell. And then if it's for an individual stock, maybe you say when it goes below a certain price, I want to sell. If the fundamental value of that business has changed, then you might want to sell, for example. And then 4, zoom out. When a crash feels catastrophic, if there's a war or we have another financial crisis, take a graph, zoom out on 10, 20 years and see the big dips. See where you are now and compare and just realize the bigger picture. When the market is in chaos, that information will be better than any financial pundit that you see on TV. All right, let's bring it all together. 5 rules for successful stock investing. 1, invest in what you understand. Stay inside your circle of competence. 2, think long term. Time in the market beats time in the market. 3, diversify, but do not over diversify. Reduce risk without losing focus. 4, understand valuation. A great company at a terrible price is a bad investment. And 5, control your emotions. The market will test you. Have a plan and stick to it. None of these rules are complicated, but applying all 5 of them, especially during crashes and moments when it's the hardest, will set you apart from 99% of people. And the thing is, you don't need to be super intelligent. You just need discipline, patience, and a bit of self-awareness to really understand when decisions are being led by emotions. If you found this useful, please give it a like and a comment. It helps the channel more than you know. It pushes the content out to people that might need it. Let me know in the comments below, which of these 5 rules do you think would be the hardest to follow? Subscribe so you can stay tuned from how to read a stock and other videos, not just about investing, but also about budgeting, saving, how to manage your money, a little bit of financial psychology in there too. If you click the bell, you'll be notified every time I upload a video, which is every 2 weeks. So thanks for watching, and I'll see you in the next one. Bye!